ACCA MOXIE students, my name is Neeraj Sen. I'm your ACCA trainer. I'm going to start the foreign currency risk management. In this chapter, we will first understand some of the key terms, then we will further go ahead and do some questions. Okay. So first, the foreign currency. What is mean by foreign currency? A foreign currency means currency other than home currency. If you are living in UK, so your home currency is GBP. Rest other currencies are foreign currency. Next is the exchange rate. Exchange rate is the rate at which currency exchange for another currency. Okay. And this exchange rate is represented in direct quote and indirect quote. So which quote is widely used? This indirect quote is mostly used in your ACCA exams, and in your ACCA exams, and also this one is also used. Okay, so I will explain. This is just a direct quote and indirect quote is just a way of representing, but it means the same thing. Like, let me show you that $1 can get 0.79 pound. Okay, but I can write this like this as well. 1 pound can get $1.27. Okay, I mean, this is the same thing I told earlier. Let me explain. Like 1 pound equal 1.79. $1.27. Okay, so 1 pound can get $1.27. Okay, right? So this next is the spread. Spread is the difference between these rates. So these rates are the buying and selling rate of the money exchanger. Have you ever been to money exchanger and they will quote you two rates? One is the buying rate and second is the selling rate. So when you convert, which rate should you use? I will tell you in the next step. If you are receiving the foreign currency, then you have to use the higher rate. If you are paying the foreign currency, you have to use lower rate. So why? Because you always at worst you always get worse rate, like you always at the lowest position. So let me explain. When you receive, so for example, you are receiving 10, so when you divide it by 2 you get 5, but you divide it by 6 you will get 1.67. so I said you always receive lower. When you receive, you always receive lower. Which one is the lower? This one. So which rate should you use? You should use higher rate. Okay, you should use higher rate. But when you pay, you have to pay higher amount. So okay, so which rate is the higher? When you divide it by lower rate, you will get higher amount. Okay, so you have to use the lower rate so that the paying amount is higher. Okay, I hope you understand this. Next one is the for future spot rate. What is the future spot rate and current spot rate? Current spot rate is the current rate that is prevailing in the market, and future spot rate is the future rate. Okay, next is the standard contract. Standard contract is standard. It means the quantity, price and time is already defined. It is also exchange traded. It means they are traded on the stock market. Okay, but in the customized contract, you go with the bank and do the customized according to your requirement. You tell how much quantity you need, at what price, and when you want to buy or sell. So it is a OTC contract. Okay. Next one is the exchange rate system. How this exchange rate fluctuate? How this exchange rate fluctuate? You can It can be defined by this exchange rate system. Okay, exchange rate is defined by if you there is one mechanism called single currency. It can be like fluctuate with the single currency dollar, or it can be linked with the basket of currency like dollar, pound, and yen. When you weighted average all these, the average all these, then you will get the exchange rate. Okay, but the first one is the your exchange home your domestic exchange rate currency exchange rate is linked to dollar, and in this your domestic currency exchange rate is linked with weighted average or basket of currencies. Okay, next one is the free float. When the exchange rate is defined by the demand and supply, then it is called free float. And if the demand and supply is managed by the central bank by buying and selling their country's currency, then it is called managed or dirty float. Okay, so I like if you in the market, if you have higher high current if your domestic currency is very high in the market, then it means the supply is higher than and the exchange rate will be go down. Then the exchange rate go down. So which means your domestic currency is depreciating. So what they will do, the central bank will buy own currency and put the supply, try to lower down the supply so that exchange rate go up. Okay, appreciate. Next one is the what is foreign currency risk. The foreign currency risk means the gain or loss due to change in exchange rate. Okay, if you gain or lose due to change in exchange rate, then means it is a risk that is you are facing due to change in exchange rate. There are three types of exchange rate risk. First one is the transaction risk, next is translation, and third one is the economic. The transaction risk is the risk that changes between transaction date and the settlement date. Transaction date is the date when you did the transaction, but when you pay, for example, if you buy something from any supplier, then when you pay 3 months or 6 months after, then you have to pay that amount, or you can say I have to settle that transaction. So transaction you buy at today, but you have to settle at future in the 3 months time or 6 months time. Okay, so let's do one question, then you will more easily understand. So today is 1st January, a UK firm enters into a contract. So let's first read explain requirement, explain risk faced by the UK firm. Okay, on 1st January, a UK firm enters into a contract to buy a piece of equipment from US for $300,000. It means if you're buying, then they have to pay dollar, right? The invoice is to be settled on 31st, 3 months after. In 3 months time, the current exchange rate is the spot. This one is the spot rate. In 3 months time, there is a risk that it might be the currency appreciate or depreciate, or you can say strengthened or depreciate. Okay, so what is the effect on our company? We lose or we gain. Our firm, we lose or we gain. So let's calculate. A UK firm and certainly over the amount of sterling they will need to use settle US dollar. Okay, so we have to convert this. If we pay 300,000, then how much the firm, UK firm, has to pay? It has to pay 187,500. Okay, but on the 31st, how much they have to pay? We have to divide it 300 by this amount and this amount. Okay, so which one should I use? So okay, let me explain, guys, which one rate you have to use, because this is the dollar. Okay, so you have to use this dollar in the denominator, and you have to multiply it by uh, uh, pound. Okay, you have to multiply it by pound, or there is no need to multiply it by pound. It means the answer will be same. Okay, 300 divide 1.75, 171,428. Okay, 429. Okay, and if you do this, so after 3 months, if the currency is strengthened, you have to pay less amount. Okay, so this is gain and this is loss for your firm, because you have to pay less. So this is gain, and you have to pay more, so this is loss for your firm. Okay, this is the risk, and this risk is called transaction risk. Okay, the next one is the translation risk and economic risks. I will explain in the next after this slide. First, we understand how can we manage this transaction risk. We can manage this transaction risk by these methods. So first is the very widely used and the ACCA is also using this method. It is very simple. Just invoice in your domestic currency. Like ACCA is a UK body, so they invoice students in GBP, so they don't have to worry about what the exchange rate. Their revenue is always the same, so they don't have to worry about the exchange rate. But when you pay, but you as a student, when you go and pay the exam fees, you always see that sometimes I have to pay more amount, but sometimes I have to pay less amount. So what ACCA does, their revenue is fixed, but we as a student, we sometimes we have to pay more, or sometimes we have to pay less, so we lose or gain. So what ACCA does, ACCA transfer the foreign currency risk to the students. Okay, this is very widely used, very easy method. So next one is the matching. So matching method is like if you are receiving 400 and you have to pay 600, so you net them and you have to only hedge 200 payment only. Okay, so you have to only payment has $200 only, right? So this is called matching. But next one is the matching asset and liability. For example, if you have an investment in foreign currency, like if you have $100 investment, but you will do, you also create a liability in dollar, like getting a loan or something. Then you will, like if the if they appreciate, then this will also, it means this balances out each other. Okay, the next one is the netting. Netting is very useful when you have so many divisions and they trade with each other and they have foreign currency involved. So what you will do, you then do like payable and receivable. Okay, a b c a b c. Okay, you will do like, what you will do, total receivable, total payable. Okay, you add them, you add, okay, you add this, and you write here, you add this, you write here, add this, you write here. Okay, let me put numbers as well. So if you have to pay 10 and 5 to like 10, 5 to 10, 5, and but if you are paying that amount, but if you are receiving, total receivable is 10, 10, 5 to, okay, then how much, like how much you have to receive 8, you are receiving 8 but you are paying 5, and okay, so for the group, as a company, this transaction is netted off and you have to only pay the net amount. Okay, so why they do this? So that the intercompany balances cancel each other and only the net amount they have to pay. Okay, okay, this is called netting. You don't have to worry about the numericals because they are not useful here. There is no question will be asked. So just understand that it is a way to save the transaction cost and only the net amount we have to hedge. Okay, intercompany, after netting intercompany balances, only the net amount we will hedge. Okay, okay, next is leading. Leading means early. Okay, leading means early and lagging means delay. Okay, delay. If you are a exporter, so if you are a exporter and the foreign currency you are going to receive will depreciate, you are expecting that the currency you are going to receive will depreciate in the future, and so what you will do, you will try to receive that as early as possible. For example, if right now 1.20, 1 pound can get $1.20. We are UK based, so our home currency is UK GBP. Okay, GBP. So we are going to receive dollar. So right now 1 pound can get $1.20, but in the future 1 pound can only get $1.20. So what you will do, you will try to receive as early as possible, because right now you will receive that dollar and convert into pound, so you will get more pound, because right now the dollar is in good position. Okay, but if you are an importer, so if you are an importer and the dollar will depreciate, then you will try to delay the payment, because right now you have to pay 1.20 per pound, but in the future you only pay 1.10, because the dollar will depreciate. Okay, I hope you understand this. So you will try to early as possible, and you will try to delay. Okay, next one is this. Next one is how can we manage these transaction risk. There are three methods right now. These are called modern methods. So first one is the money market has, second is forward contract, and third is derivatives. In derivatives we have futures and options, but at this stage we don't have any numerical questions. Only first and second is tested, money market and forward contract in FM. Okay, so money market hedge. In money market hedge, short term instruments are traded. Okay, how we hedge risk? We hedge risk by borrowing and investing. By borrowing and investing short term instruments. Okay, let's do next question. Then you will understand. So if you are an exporter, so you will receive the foreign currency. Okay, you will receive foreign currency. So what is your risk? Your risk is that if dollar depreciate, okay, reduction in value of dollar, this is the risk. Okay, so what you will do, you will try to borrow, convert and invest. These are three steps you have to follow in order to hedge the risk. Okay, so borrow, you borrow at borrowing rate and convert this into present value. Okay, borrow at borrowing rate but convert at present value. When you convert that, but this is the dollar, and this one is the foreign currency rate of borrowing rate of foreign currency. Okay, this is the dollar value, but you have to then convert that. Okay, actually my pen is not working. If you are an exporter, then you will receive the foreign currency like dollar. Okay, so your risk is that the foreign currency you are going to receive will depreciate. If this depreciate, then you will lose, you will have a loss, right? But how can we hedge this risk? We can hedge this risk by using money market hedge, by borrowing, converting and investing. Okay, these are three steps we have to follow. Okay, so we have to calculate the present value of the borrowing. We need to borrow how much amount we have to borrow. That amount we have to calculate in present value terms. This borrowing rate is the foreign currency borrowing rate of foreign currency. Okay, and the amount you will get in dollar. Okay, dollar, present value of borrowing in dollar terms, but then you convert that into home currency. Okay, using spot rate. Okay, at today. Okay, then you have to deposit that rate, then you have to deposit that amount at deposit rate of home currency. Okay, borrowing rate of foreign currency. Okay, these are the simple three steps we need to follow. And then what they are doing by doing this, let me explain that. Right now we have, for example, this is asset, this is liability. For example, we are receiving dollar amount. Okay, this receivable, we are going to receive dollar amount, but now we will create a liability in dollar. Okay, we will create liability in dollar, like borrowing in dollar. Okay, borrowing in dollar, we created one liability. Okay, but if we invested that, if we invested in pound. Okay, so if the dollar value increase, this asset will increase, but this will reduce, because if you are receiving more money, but we have to pay more as well, right? So net there is no benefit and there is no loss. Okay, so at the end we are going to receive that amount after maturity. After maturity we will receive that amount. Okay, and when we receive from the supply, when we receive from our customer, then what we will do, that amount we borrowed, we pay that loan, but we receive that, we receive after maturity from this investment. Okay, I hope you understand this. We will do one question on this, so that you will understand more easily. This is very highly tested in this chapter, so you have to be, guys, very attentive and understand all these steps so that you don't have any problem when you solve the questions. Okay, next one is the opposite of this. If you are an importer, then you will have to pay the foreign currency like dollar. Your risk is that if after 3 months or 6 months your dollar value you are going to pay will increase, so you have to pay more amount, right? Your dollar value will increase or your home currency like pound will depreciate, so you have to pay more. Okay, so these are the 3 steps we need to follow, right? First is invest, then convert, then borrow. Simple, but only the opposite of these steps. In the receipt, in the payment, we do opposite of the receipt. Okay, foreign currency we take deposit rate of foreign currency. Okay, this is the dollar value, we convert that into pound. Okay, spot rate using, then we invest that dollar amount using borrowing rate of home currency. Okay, this is the total payment, this is the total receipt. Generally this is the question, that how much we will receive or how much we have to pay. So this is your answer in each case. Okay, the next one is this, sorry, the next one question on receipt, and the next one is for payment. Okay, so let's do this receipt question. A company whose home currency is the dollar. Oh, okay, this is the, right now we are in USA. Okay, right now USA is our home currency. Okay, we are a company whose home currency is dollar. Okay, expect to receive peso. So foreign currency is peso. We are going to receive in 6 months from a customer in foreign currency. The following interest is available: spot rate, spot 6 months. Okay, home currency and home country and foreign country. Okay, so guys, remember that you are going to receive. Okay, you are going to receive R D C I. Okay, how much you are going to receive? The present value you have to calculate. Present value borrowing, how much peso, then you have to divide it by peso, right? You have to divide it by, okay, 1 plus the home country Back to receive peso. Okay, sorry. The foreign currency borrowing rate. Okay, this one is the borrowing rate. 8 divide 100. You always have to do this for 6 months. After 6 months, okay, 8 1 plus 0.04. Okay, 0.04. 8 0.04. Okay, borrowing 500 for how much? 48769. Okay, you have to convert that at spot rate. Spot rate is this is peso, right? This is peso. So we have to divide it by peso. Okay, 15 equal how much dollar? 32051. Okay, then we have to invest that. This is dollar. We have to invest at 1 plus have to invest that deposit rate. Okay, T for 6 months. T one 32051. Okay, 32531.76, or we can say 32. Okay, nearest 100 6 month dollar receipt. Okay, so 32,500. We can say that this is 32,500. Okay, nearest rounded off. After round off, this is the right answer. I hope everyone can understand this. Next, we will do the payment, and you can more easily understand this. A US company owes a European company. Owes means you have to pay. You borrowed, okay, right? You borrowed something. You have to pay to European company how much? 3.5 million in 3 months. The spot exchange rate, spot is current annual interest rate. It will be the equivalent US dollar value payment using money market hedge. Okay, so payment I C E, invest, convert, borrow. Okay, so this is the payment, invest, convert, borrow. Now the opposite of the receipt, right? Now we have to do the opposite of the receipt. Okay, so right now how much? 3.5 million have to have to invest that investing euro, investing in euro 1 divided after 3 months. Okay. Oh, okay. This is the euro value. Right, 1.025 49127 and say this 2, right? So you convert that into, this is the euro, so you have to divide it by euro. Okay, so which rate should you use? We are going to pay, right? So means we have to use the lower rate because dividing by lower rate give you higher amount, because we are going to pay, so we always at worst rate. Okay, we always choose worst rate, so that we in case of payment we always pay more, but in case of receipt we always receive less. Okay, so we always at worst position, always at worst position, so we use 1.96 dollar 1781261 one. This is the dollar 1781261 1 plus, you have to multiply it by this borrow in US. Okay, USD 8 multiplied 3 divided 12 much 8 divided 100 multiplied 3 divided 12. Okay, 0.02. Okay, 1781261 1711816 18. This is the right answer. Okay, this is the right answer, guys. I hope everyone can understand this. You just need to remember what you are going to either you are receiving or you are paying. If you are receiving, then you have to first borrow, then convert, then invest. If you are paying, first you have to invest, then convert, then borrow. Okay, and always remember that in this which rate you have to choose, and always divide it by 100 and multiplied it by the months, how much months, by the you have to you are how many months after you are receiving or paying. Okay, these are the main steps, and which rate you have to choose. If you are receiving money, you have to choose higher rate. If you are paying money, you have to choose lower rate, because dividing by higher rate will give you lower receipt, but dividing by lower rate will give you higher amount, because in payment you will pay more, but in receive, when you receive, you have to receive less. Okay, because we always at the worst position, and we always lose, but bank always gain, right? So I hope you understand all these. Next, move on. The forward contract. The forward contract is another hedging mechanism. In forward contract, we go to bank and we set a rate that is called forward rate. Okay, we go to bank and set the forward rate. This way we can hedge the forward, hedge the risk. A forward contract with a bank means these are the over the counter contract between two parties. Fix the exchange rate on a specified amount. How much amount you want to hedge, you specify, and the date you specify. Okay, which is agreed now for the future, right? So let's do one question and you will understand. If the agreed rate is higher or lower, then bank will pay sometime, or sometime we have to pay, but sometime bank will receive, right? Okay, let's do one question and you will understand. The home currency is pound and we are going to receive 500 in 6 months. Okay, the spot rate is this, and we set bank offered this rate, right? We are receiving, so which rate should we use? Because we are receiving, so we are always use the higher rate. Remember, because when we use higher rate, the amount we are receiving is less. Okay, because in receipt we receive less, but in payment we pay more. Okay, so for example, if 10 is divided by 4, 10 is divided by 4, this is the amount. But if 10 is divided by 2, means which means if we are dividing by higher amount, then we will get lower amount. Okay, but if we are dividing by lower amount, we are getting higher amount. I hope you can understand this basic math. Okay, we convert that at spot rate. So if right now we convert that amount, so we receive this amount, but we go to bank and we fix the rate. So how much is the rate? We use higher rate. So if the bank, after 3 months we receive this amount, but today if we receive this amount, so in the future we are receiving less amount, right? So we lose due to forward contract. How much we lose? We lost 381,679 minus 5. We lost 5739. Okay, we lost this amount. So we so what? Because hedging is a mechanism in which we never lose or never gain, right? It's a way of hedging the risk. So what bank will do? Bank will pay us this amount. So we will receive we will receive this amount. Okay, but for example, if the forward rate we set is this is I am assuming, okay, this is I am assuming right now just for the example. Okay, so if the forward rate is this, so if the forward rate is this, then we have to use this rate. So now we are getting more, we are getting more due to forward contract. Because we are getting more due to forward contract, we gain due to forward contract. How much we gain? We gain 625 275 have we gain due to forward contract 14,865 we gain due to forward contract. But the forward contract is not a way of making profit or loss. So that's why we have to pay to bank we have to pay to bank this amount. We have to pay this amount to bank. Okay, ultimately we are receiving the same amount whether we convert that at spot or at the future. We are still getting same amount, right? This amount we are getting whatever the rate in the future. So this is a way of mechanism. I think you can understand this. Very easy, just need more steps. Okay, it's a what are some advantage and this one disadvantage. Is a tailored contract, has full amount because in future and options they are exchange traded, so there is a lot size and there is a lot size, so you have to buy that full lot size or you cannot buy, right? But in case of forward contract, you can hedge any amount, right? So this is the you can hedge full amount. It's easy to understand counterparty risk because there is no margin requirement in this case. But in case of future and options, you have margin requirement. If you any of you guys are doing trading or demat account you have, then you can understand this. When you go for future and options or derivatives, you have to deposit the margin amount, right? But in case of forward contract, you don't need to deposit any margin amount. So there is a risk that other party may default or may not if the go rate go against them, right? Like you if you gain, you don't pay this amount to the bank, right? If you lose, bank will not pay you amount. This is the default, right? This is the risk. So next is the you have to execute the contract. It's a obligation that you have to execute the contract. Obligation that you have to execute the contract, right? And it is not tradable. Four-way equivalence model. This is another very important topic, but these are these interest rate parity and purchasing power parity is mostly tested in our exams. Okay, so let me explain the Fisher effect. Fisher effect says that the difference between the currencies are due to this. The Fisher effect says that the nominal interest rate is equals the real rate and inflation. Okay, nominal rate includes real rate and inflation. For example, if you are getting interest of 4 from the bank, if you are getting interest of 4 from the bank and inflation rate is 6, so now you are getting 10% interest rate, but this is the nominal interest rate you are getting from the bank on your deposit. But after excluding the inflation, because 6 uh, because out of 10, 6 you are getting due to the inflation, so the real return you are getting is only 4. Okay, the real return you are getting from the bank is 4. This is the explanation behind this. Okay, I hope you can understand. So next is the Fisher effect. The international Fisher effect says that the interest rate between two currencies equals is equal to difference in expected inflation rates between two currencies, which in turn affect the interest rate. Okay, this is not very important, but I can still explain that the interest rate between two currencies is equal if due to the interest rate between two currencies equals the expected inflation, okay, between two currencies. So the interest rate and inflation rate is equal between two currencies. Okay, the difference is only due to difference between these. Okay, in inflation rate, which is affected by exchange rate. Okay, and this interest rate and inflation rate, is affected by exchange rate. Okay, this is not very important. Expectation theory claims that current forward rate is just predictor of spot rate is predictor of spot rate in the future. So it means the future is the future. The current forward rate and spot rate difference is due to the market expectations of future exchange rate, because the investors, or because we as a company, we are expecting that our exchange rate maybe go appreciate or depreciate. So this is our assumption, and this difference rate is due to our market expectations, because of our market expectations. Okay, so this one is equals to this one is equals this one is equal this one. Okay, this is examinable, this one is also examinable, then these three are not very important at FM. So let's do one. The factors that influence the exchange rate. Which factors influence the exchange rate? Balance of payment. You know what is the balance of payment? If you import more than your export, which means the supply of your home currency in the market will increase. Supply of home currency in the foreign market will increase, which means that the foreigner will come to your country and try to buy your products at very high price. Try to buy goods at high price because they have so much of your home currency, so they will try to give the good amount of price to you. So what will happen? The inflation will increase. So if higher the inflation, your currency will depreciate, your currency value will depreciate. Okay, this is the explanation. So revenue converted into domestic. So the balance of payment deficit can therefore weaken domestic currency over the long term. Okay. The inflation purchasing power parity theory. Higher the inflation, I already explained. If the higher the inflation in a foreign country, it erode the purchasing power parity of the currency. It means if there is high inflation, which means the prices are higher for goods than earlier. Right now the prices are higher than the goods it was earlier, which means that same, for example, 1 pound can get less quantity of item. Same 1 pound can now get less quantity of item, which means the purchasing power parity is depreciated. Okay, due to inflation. So inflation is bad effect on the purchasing power parity. Okay, so our spot rate will also reduce, expected spot rate. So this is the formula for calculating this. B is the home base currency, or you can say home currency, and this is the foreign currency, base currency. You can say base currency or home currency, and you can calculate this by formula. Let's do one question on this so that you can understand. What is the expected spot rate at the end of the year, which means S1? Okay, and company is based in country A, who the spot exchange rate between country A, the dollar, and country B, krona. Okay, so right now $1 can get 8 krona. Assuming that there is now purchasing power parity and amount of commodity costing 110 in costing will cost 880 in country B. Okay, over the years the price of inflation in country B is expected to be 5, and in A, in B, and in A, in A, in A, A. So A is our home currency. This is the foreign currency. So 8 is foreign, 8 is the krona. This is the foreign currency, so we have to multiply it by 1.08, 1.05. This is foreign currency. This is base currency or home currency, you can say. So we will get 7.778. This is the S1, expected spot rate. You can calculate this by another method. This one is actually the inflated this cost with the inflation rate, and inflated this one with the inflation rate of that country, and later on they divide. It actually means the same amount, same answer you will get. Okay, next is the interest rate parity. Interest rate parity is a country with high interest rate, which means the bank are giving high interest rate on deposit, which means the higher the supply of home currency in the domestic consumers, in the hands of domestic consumer. So if you have more money, you will quote higher price for items. If you quote higher price for items, which means the inflation, the prices or inflation, you can say, will increase. So your currency value will depreciate again. Okay, so a country whose interest rate deposit normally has a currency at discount, which means depreciate. Okay, in relation to country whose currency has lower interest rate structure, and vice versa. Investor can indifferent between currency can give same return even if different due to interest rate parity. It says that because of different interest rate between different countries, it does not mean that you can gain from different interest rate, because the inflation will be higher in that country, so that the real actual return will be adjusted, right? So actual return is almost equal, but this is the only you are getting, only the difference is visible, but actually the difference will be eliminated in future. Okay, so banks use interest rate to calculate forward exchange rate. The bank use this interest rate to give you a forward rate. This forward rate is given to you by bank. Bank use this method to quote the forward rate. High deposit means more money in the hands of people. Okay, how can you calculate the forward rate? This way, and base currency and foreign currency. Okay, let's do one question. It's very simple, similar to we did earlier. A company is in country A. Home currency is expected to receive foreign currency in 6 months time. The spot rate, annual interest rate is 8 in country A. Country A is home country, home currency and foreign currency. Okay, calculate the forward exchange rate in 6 months time. Means the F0, right? So how can we calculate? Let's do right now the spot rate is this, so we have to multiply it by, this is the dinar, so this is the dinar rate. Dinar inflation rate is 6, because because we are only using for 6 months. So 0.03, okay. And for this, again 0.04, okay. So the future spot rate will be 5.4. This is very easily understandable. Okay, I hope guys all these my explanation helped you a lot in your exam. And further, in the next video we will try to solve questions based on this. We will try to solve all the questions from the Kaplan exam kit. Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.